Good morning and welcome from Barcelona. My name is Raksha Darenani Thani. I'm joining you from Barcelona on behalf of HOSCO as your host today. This webinar titled The Business Savvy Leader, Financial Insights Every Hospitality Manager Should Master is brought to you by EHL Hospitality Business School in collaboration with HOSCO. I'll give you a couple of minutes to sign in and I'll tell you a little bit about HOSCO in the meantime. If you haven't heard of us, we're a company that started up in 2011 to bring together the entire hospitality industry. On HOSCO, you can post jobs, find educational institutions, and you can find employers, and you can connect with each other. We currently have about 2 million hospitality students and professionals. We have more than 400 hospitality schools and more than 1,000 world-class companies. Today's masterclass is really, really important. I know finance is not everybody's cup of tea, but I think we're going to make it really interesting for you because hospitality leaders must now balance passion for service with financial accountability. And it is important to align your operational KPIs with owner and investor expectations. So we have two experts here who are going to give you both the academic and the professional perspective. And they are none other than Benoît Perrier, who is a lecturer at EHL. He is an academic and he will give you an investor level finance perspective. Benoît, would you like to say a few words about yourself?
Yes, sure. Thank you, and welcome everyone. So I started my career actually in finance in London. I worked for Barclays for 6 years in equity research, and then I was a research manager also in equity research in Credit Suisse. That doesn't exist anymore, unfortunately. This was in Zurich, in Switzerland, and since 2018, I am teaching at EHL Business School in Lausanne.
Perfect. Thank you so much, Benoît. And the next person we have is none other than Frank Marrenbach. He is the CEO and managing partner at Althoff Hotels, and he's going to give you the perspective of working closely with owners and asset managers. Frank, over to you.
Thank you, Raksha. Good morning to everybody. Frank Marrenbach, my name is. I'm a hotelier by trade. I have an international career, worked in Paris and London, and I studied abroad in the US. I ran Oetker Collection for about 20 years and bought a portion of Althoff Hotels some 6 years ago and became managing partner.
Fabulous. Thank you. And so just to give you some housekeeping for our viewers today, you're going to start with a presentation by Benoît and Frank. And you will get a chance to pay attention, watch the slides. He's going to explain in detail. And then Frank is going to weigh in with his professional insights from his own experience. And then we'll engage in a short panel discussion. And at the very end, you will have a chance to ask your questions. So go ahead and pop them in the Q&A. The chat is closed. The Q&A is open. So pop them in there. And if you're afraid that you can't watch the whole session or you want to replay it or share it with someone else, don't worry. You will get a YouTube recording within a week's time. So over to you, Benoît and Frank.
Benoît, you might be on mute.
Yes, I was going to ask for Benoît. Benoît, able to hear you? Perhaps you are on mute.
Sorry about that. Sorry, I think I'm muted here. So it's really a shame because it was very interesting what I was saying, but I will start again just for you. So I was saying when I work at Barclays in equity research, so equity research is a division where you look for company to give investment advices to potential investors, whether they should buy, hold, or sell a stock. We get this vision of what investors should look at. And there are not a lot of things we look at. Mainly two things. I will show this to you. But I built this vision of from an investment point of view. When we invest, when we pick companies to invest in, what do we look at? And I want to transfer this to you, either because one day you will become an investor yourself, and you may want to understand the logic behind it, Or maybe you want to convince an investor to invest into your company. And having the background about what we are looking for as investors is, of course, very useful in the process of convincing those investors. Right. So what is the goal of any company? I always start with this concept in any finance class I give to my students. For some of them, it's a bit shocking, but the goal of any company is to maximize long-term shareholder value. So this is capitalism. You may like it or not, but this is how the economy, how the business is working actually. And this should be understood by everyone. So we have. I'm just not talking about the company has a vision, a mission. A company must respect ethics. Of course, this is clear. It's not treated here, but we should keep this in mind. But when we focus about the goal of the company, beside those areas, the goal is to create value. So the question you may want to ask yourself is, how do we create this value for shareholders? There are actually two ways to do this. Dividends, so it's giving back the value, the cash directly to shareholders, or capital gains. This is a more speculative approach. The shareholder is buying the share of your company at $10 with the hope that in 2 years from now, it's going to be $20 and that he or she will be able to make a profit by selling it back. Both give wealth to the shareholders. Both is actually a transfer of value from the company to the investors. So now we deep dive into those two, dividends and capital gains. So dividend, you need cash. So the company may need cash to pay dividends. So this is on the balance sheet. This is an area that investor will scrutinize. You need cash to give cash away to your shareholders. When you pay dividend, you also need what we call distributable reserve. It's very often called retained earnings, mainly in the US. It can also be accumulated earnings, independent of the terminology and the standard of accounting. But from a legal standpoint, you need reserves to pay out dividend. So we see just after how we build those reserves. Second way to create value for your shareholders, we mentioned this, capital gain. This is driven by higher expected future cash flow. We talk about cash flow just after. DCF, discounted cash flow, of FCF, free cash flow. So if you invest into a listed company, this calculation is not needed. You know the value of the company with a share price. So you know. If you invest in the private equity in companies that are not listed on the market, you never know the value of your share. So you need to make calculations to get this value. And I show you how we do that. Also, if you invest in a listed company, you know the share price today. But if you want to project the share price in 2, 3, or 5 years, you will need to make a forecast of those the value of your company, and you will also use the cash flow to do so. So we go back to dividend. I already introduced this dividend that you give to your shareholders. So dividend is a very quick way to reward your shareholders. If you pay out dividend, you may impair your ability to invest on strategic investment in the future, to deleveraging your company, but you will please for sure your shareholders. Do we have to pay dividend? No. So usually when a company is not making any profit, the company will not pay dividend, but there are exceptions. And usually when company is making profit, the company will pay out dividend, but this is not a rule. So this is also something that maybe most of you and some students struggle with or don't know at the beginning. You don't have to pay out dividend even if you make huge profit. We have a very good example with the company Apple that made huge profit between 2012 and 2018. Huge profit every year, but not a single dividend was paid out. Why? Apple preferred to reinvest this money to grow faster. And also the share price of Apple increased so dramatically during that period that we may assume that Apple considered that the share price increase was already enough to reward the shareholders. But now, if you decide you pay dividend, what do you need? You need cash. I'm going to explain what cash is, but you need retained earnings. Maybe you did some of you did some accounting. So when you pay out dividend, this is a journal entry you have. So cash on the credit, meaning you will reduce your cash, and you have retained earnings on the debit, meaning you will also reduce this account. So from a legal standpoint, if you don't have any retained earnings, you cannot pay out dividend. So the question now is, how do I build these retained earnings? And maybe you understood it already or you knew it from before, but I will explain this for everyone. Retained earnings or accumulated earnings are actually the net income, the earnings that the company has made in the previous years since inception. So the net income from the P&L at the end of the year, the net income will go into the balance sheet, section equity, in the account retained earnings. So you need to feed this account year after year to have an amount here. Why? You need to feed it so you are able to pay your dividend, because a journal dividend is like this. So the question now is, how do we increase retained earnings? Maybe you understood it already. If you increase retained earnings by a net income year after years, it means everything on the P&L, profit and loss, everything making the net income will affect indirectly your ability to pay out dividend. And on the P&L, you know what we have. We have revenue minus expenses. So actually, in the everyday operation of your company, every additional revenue may allow you to increase your dividend policy, and any additional expense may impair your ability to pay out dividend in the future. So that's opened the door to a lot of ratios to monitor this, because all the ratio looking at the P&L and the net income will be somewhat relevant for shareholders. This is for dividend. We park it for now. We go to the other way to create value for shareholders, which are a capital gain. It's a bit more technical, but I try to be as easygoing as possible. So the firm value is calculated, I'm sure some of you know that, using free cash flow. Call it discounted cash flow. And which type of cash flow do we discount? We discount the free cash flow. Why do we call them free? Because the company is free to use them as it wants. So this cash can be used anywhere. Okay, there is no obligation. This is additional cash. You do whatever you want with it. So what you can do with that, it's here. You can use it to grow. So you were operating 3 hotels. You may want to buy another hotel with a free cash flow. We call it strategic investment. You may use it to pay back your debt into some condition. This may add value, but usually this is not always a good idea because you limit your leverage. Or you can use it to return to shareholders, and you understood this is a dividend. So this is why it's interesting. You see, those 3 possibilities: growing your company, paying back your debt, or giving back the money to your shareholders, is actually to the benefit of the shareholders. If you give it as a dividend, then the shareholders receive cash directly, is very happy. But if you say we don't pay dividend, but we're going to grow the company with the cash, the shareholders are also very happy. He bought the shares 10 years ago. He has a company with only 3 hotels. And now, without paying anything on top of that, the company he owns or she owns has 4 hotels. So the value that the shareholders hold is actually increasing as well. That's why we take this free cash flow to compute the value created by the company for the shareholders, because anyways, this value is going to increase the wealth of the shareholders. So free cash flow, I need to be a bit technical here to explain you how it is calculated. It's on, I think, on the next slide. But before, be careful, maybe some of you are confused with that. The cash flow is the cash the company get in minus the cash the company spend every year. It's not the same as profit. Profit is revenue minus sales. So for example, in the profit, the CapEx, the money you invest in your long-term asset, is not included. So the profit is only the P&L. So it's not the same thing. You can understand this with this slide. This is how we calculate free cash flow. So we just step back a little bit here. This value here is going to be used to calculate the enterprise value. So the sum of all the future free cash flow that you forecast for the company is going to make the value of your company. So this is how we calculate it. EBIT, earning before interest and tax, minus the tax the company pays, plus depreciation and amortization. This is a bit technical, but we add it back because we want to have the earnings excluding the depreciation and amortization. So we add it back. Minus changes in working capital. So working capital is everything you need for your inventory to manage your suppliers, payment, and so on. So this is also may consume some cash. Minus net capex. So this is very important. The capex here, so the capital expenditure to maintain your asset, to maintain the value of your hotel is usually a huge cash outflow. This is taken into account in the free cash flow. Once you have this, you got your free cash flow for 1 year, T here, and you will multiply it or you will forecast it for 10 at Barclays. We did that for 20 years. Usually free cash flow was calculated over 20 years. So you forecast this for 20 years. You add the terminal value. I'm not going to get into the detail of this. You add the terminal value and you find the enterprise value. For example, 100 million. So this is the value of the company you're invested in. And the next step we do, but this is when I work at equity research, is we divide the enterprise value by the number of shares, for example, 100 million shares, and we find the theoretical price of one share, $1. And then if the stock price on the market is $0.5, we see an opportunity of investment. But we're going too far here. We just need to step back just before. So this is how shareholders value the enterprise he has invested in. So cash flow are very important from the perspective of shareholders. So now that we know this, we know what shareholders are looking at in terms of value creation. Which ratio can we link to this? So we have a list of different ratio here, not ratios, but indicator that shareholders may want to look at. So first on the dividend side, the distribution. So the cash is very important, and the distributable reserve, retained earnings are going to be scrutinized by investors. In the dark blue, other indicators, the operating performance, so revenue growth, cost control is important because it will define your EBIT, and your EBIT is one of the bricks making your free cash flow. So the EBIT will affect the value of the company as it is perceived by the shareholders. Working capital discipline. Net working capital must be maintained at a minimum. So this is, I'm not going to enter into detail, just being conscious of time, but this is how you play with your inventory cost, suppliers, customer with late payment, and so on. This will consume net working capital. You want to minimize it. Last in this section, the CapEx efficiency. A company has a normal capex, and this is fine to spend cash into maintaining your asset. But when you do so, you need to make sure the return on this capex, the return on this investment, is higher than the WACC. I'm not going to get into detail at this stage into the WACC, but the WACC is the cost of capital, meaning what it costs to investors and lenders to invest into your company. So the return must be always higher than the WACC. So for some companies that have a very low WACC, for example, Nestlé, a matured, secured company, they may invest in projects with a smaller return on invested capital compared to other companies that are a bit more risky. And the risk, this is the last point here. So this is the WACC. There are different ways to reduce the WACC, but keeping in mind that the WACC is actually adverse to your company. You want to minimize it, so you may accept projects with a lower ROIC. This is from financial perspective. I would like to zoom out a little bit now. So on the financial perspective, this is how you create value. And even if the end goal of a company may be this creation of value for finance, for investors, this is correlated. This is linked with other areas, with the customer. If you play well with your customer, you may build a brand loyalty that will also in the end create value for your shareholders. Your process, if you have a good process quality internally, you may save cost. Then you may increase your net income, that will increase your retained earnings. You may also increase your EBIT, that will increase your free cash flow. And then learning and growth perspective, so you can better capture the value your company is able to generate. So now if we take this into a bigger picture, if we link it everything together from the customer satisfaction to the shareholder value, there is a link between this, but with many other operational metrics. But I take this customer satisfaction. By increasing the customer satisfaction, you may increase loyalty, positive review, visibility, and reputation. This, as you may know, will strengthen your pricing power and increase your demand, so occupancy and ADR. That will increase your RevPAR, increasing your margin, and increasing your free cash flow. This is where shareholders find their interest back. That will increase the enterprise value and the shareholder value at the same time. So there is a link, there is a continuum of effect between increasing your customer satisfaction and increasing the shareholder value for your investors. So now we try to break this down into different ratios. So maybe you understood it, but the shareholder return is strongly correlated with P&L. So any ratio looking at the P&L are relevant, but I've selected for you just a few here. So first, the distribution of your dividend, how much dividend compared to the net income the company is paying out. It can be 100%. It's very unusual. Usually companies do half, as they will reinvest half or some of the profit into the business to make sure the assets are maintained at their value or the company grow. And then the other part is giving away to shareholders, so they also get reward for their investment. So this is something we look at, this ratio, dividend payout. And then the other way to create value for shareholders, as you know now, is value creation. So EBITDA margin is very important. You need to be profitable if you want your net income to increase and the EBIT to increase. That will transform into enterprise value increased. And we always compare the return on invested capital versus the WACC, keeping in mind that this return should be always higher than the WACC. Interestingly, the WACC is different for any company. This cost of capital is not the same for two companies, so you have to calculate it, company or for the company you're investing in. But again, for some company, it will be easy. For a low-risk company, they may accept a project with a lower return. But for very high-risky companies, startups, for example, they have to get return, a very high return, because you need to beat the WACC. Last but not least, on the risk the company is taking, this may also affect the WACC. The debt you have compared to your EBITDA, are you able to pay out your debt at some point with the profit you're making? And then the interest coverage, just to make sure for some company in difficulty maybe, that you're still able to pay your interest. As you know, if you're not able to pay interest or debt, you will go bankrupt, and investors may want to avoid this at all costs. So EBIT divided by interest expense, that we call debt service, is also scrutinized by shareholders. So this is how we make the link between the value we generate for shareholders and the ratio you may use from a financial point of view. We mentioned this before. This is also related to operation, and we have a lot of operating ratio that also may feed the value for the investors. But for this section, I will hand it over to Frank Marrenbach.
Benoît, thank you very much. I found it extremely interesting. I remember my school days, so I can confirm so far that everything what you said is correct. And maybe I can flank it with a bit of stories from an operational point of view. To our dear audience, from what point of view do I look at it? So Althoff Hotels, it's a privately owned company run by us. We employ 2,000 people. We have an annual turnover of 200 million. So it's not a small operation. It's not a large operation. It's like typical Mittelstand. But of course, we are in the value game. A long time ago, when I was much younger, one of my professors said, "Frank, you have a lot of ideas. If they don't jingle, they don't count." Okay, so what did he mean at that time? He said, great ideas are great ideas if they translate into value. And Benoît clearly said it's not about creating short-term value because you can, deduct cost, you can reduce cost. It's about long-term value. So it requires, of course, strategy and a long-term view on things. But in order to build businesses, you have to have enough money left. So it is so banal, but in daily business, sometimes complicated. I let you look into my own situation. I started with Althoff Hotels in May 2020. You might remember what that was. It was the beginning of Corona. All hotels were closed, and we were facing a super difficult situation. We only survived because we retained earnings over a long period of time. So we had a healthy, situation. But I can assure you, it takes years to build up a proper equity position. It takes months, really like snow exposed to sun, to have it, melted. So that's what you really need to keep in mind. I guess we all, and I'm a hotelier by trade, passion is a super important ingredient. We build businesses because we love people. We want to make guests happy. We want to develop people. So the main ingredient and the base, maybe we get up for in the morning is this passion for hospitality. So the question is, how do you then control the passion or direct the passion in more, strategic thinking and financial thinking? This morning, when I opened the news, maybe related to a couple of incidents in the hospitality industry, some larger firms being in a difficult situation, facing bankruptcy. The analyst said, a colleague of Benoît, said today, what are investors looking at? Operational efficiency, healthy balance sheets become sometimes even more important than the brand. So, I mean, listen to this, this is, how can that be? How can that be more important than the brand? Because investors also want long-term relation with the partners they do business. So for them, it's essential that the companies are able really to perform well. For us, it's important we always run our company in a way that it can be sold at any given point in time. But we don't want to sell it. It belongs to the families, our sons in the business, but it's the only way to look at it. Is this company in a financial good situation? So when you look at the title hospitality specifics, you will see that a lot correlates 100% with Monsieur Perrier's statements. The first one, RevPAR, you all might be familiar with revenue per available room, all right? And so I guess it's a metrics we all use, but important is, you need to put it into a context. So you look at your market and you define your comp set because you want to know, am I performing above or below my competitors? So the RGI, the revenue generating index for us is really important because let's say you have your RevPAR increases. Is that a good thing? Of course, it's a good thing, but does it increase at a level the competition increases its RevPAR? And that is really important. So the index we look at very carefully. We combine it then, and that's the next line, with the so-called CQI. It's the competitive qualitative index. You also have a look how the hotels are perceived by the guests. Are you as good as your competition or are you better? And for what reasons are you better? What do the guests like more with you? Is it the food? Is it the location? Is it the design, the service? So these two metrics, the RGI and the CQI, in theory and in practice, they often correlate. If you are superior in your ability to create a higher rate and a higher occupancy, mostly it's related also to the happiness of your guests. That's my experience. It doesn't correlate at any point in time, but if you look at, a quarter, a year, my experience, it's always, it's always close to each other. So then the GOP margin. This is the super important metric for the hotel team because it's what they can influence. It's the gross operating profit, as you know, they can influence it. Us as owners, we look at, for me, my ultimate number is the earning before taxes. This is what we make in order to reinvest, to retain everything which was said before. CapEx intensity. In my long professional life, I often saw that, in order to, have a better financial result, companies tend to invest less. This is, one of the most dangerous mistakes you can make because guests will always punish you for that. Other competitors will do better, and then you will not be able to maintain a proper competitive situation. So I look carefully, do we reinvest enough to keep a property up to par or even at a better level compared to the competition? But in order to do this, you need to create healthy profit margins, GOP, so it all correlates. The next specific might surprise you. It's called the lease coverage. Why would we, and by the way, we own some of our hotels, most of them we lease. So you might ask yourself the question, why would Frank look at lease coverage? It's not, his thing. He pays rent to the landlord, and it's the thing of the landlord. But I need to be able to see, if the real estate owner, is also feels comfortable. So is it 1.2, 1.4, 1.5? So I view things as an owner, even if we don't own the real estate in some cases. So it's really important. And I can assert you, if you negotiate new contracts, it's something any investor will look at, okay? So you present the business plan. And by the way, it's not about presenting the most optimistic case on the planet if you sign a lease agreement, okay? It's a, it should be a realistic view, can be optimistic, realistic view on what the hotel can do in terms of numbers. And then, your, the real estate owner or your partner, to-be partner, will look at if this is kind of safe. Why? If you are barely making, it to pay the lease, any landlord, any investor will be uncertain if over a long period of collaboration, and mostly it's 20 years, this is sustainable. And you see this in the past year that often companies cannot make it. So then the real estate owner has to look for a new brand, a new owner. So my experience is not, any investor has a long-term view on it and is not looking at the highest return, in the first 2-3 years. He wants to have a sustainable business case. And obviously, last but not least, we look at ratings and investment ratings. There are a few out there. So Althoff Hotels has a AA, which is, we are a German-based company, and out of the 100+ company listed there, only 7, have a AA ranking. So for us, that's important when we speak to banks and other interested parties to demonstrate that, as a partner, we are reliable, that we pay our, rent, that we, can perform not only the next year, but for the years to come. And therefore, we look at this too. So in short, it correlates big time with the ratios you heard before. And therefore, it is ultimately important that you, as, upcoming young, investors yourself, to be managers, that you embed this thinking at a very early stage of your career. Benoît, back to you.
Yeah, I think I'm done with the presentation. Raksha, maybe it's back to you now.
Yes, thank you, gentlemen, for both of your presentations. Very, very helpful. And even for someone like me who has very little knowledge, think I learned something quite important there. Let's go over the questions. Let's go over to them. Benoît, I'll start with you. Which financial ratios do investors and owners monitor most closely to assess value creation?
Yeah, well, this is a bit what we have on this slide here. The most important ratio are the ratio looking at the wealth you may generate throughout those two channels that are dividend payment or cash flow that can be reinvested in your business. So any P&L ratio will be important. First of them being the EBITDA margin. This is the first condition, sine qua non condition, to have a positive EBITDA margin. If you have a negative profit, of course, you're just destroying value for the shareholders. You're not able to pay out a dividend, as we've seen before, because you're not building retained earnings. So this is the first condition. You have to monitor your P&L to get a positive net income, which very often goes with a positive EBITDA margin. This EBITDA margin as a ratio may be compared to the competition. If you are looking at two similar companies and you don't know in which one you wish to invest, you may wish to go for the first company because the EBITDA margin is higher. But that ratio doesn't capture the capex. So you may have a very high EBITDA margin, but to maintain this level of service for your customer, you have to invest a lot of cash in the business. This is not captured by the EBITDA. As you all know, there is no cash on the P&L, but just expenses and revenue. So this is not enough. This is not enough. It's quite easy for any company to have a very nice EBITDA margin by reinvesting a lot of capex, but you're still not creating any value for the shareholders, even with a positive EBITDA. This is where the return on invested capital, ROIC, comes into the game. And this is also a very important ratio. It tells you based on the capital you invest. So here you will link together for the first time a P&L metric, the return, with the investment. So the question is, how much investment do I need to get this level of return? And the answer is, I want to make the minimum investment possible to be sure, and at the same time, be sure to get the highest return possible. And this ratio, combining those two, must be, as we've seen, higher than the WACC, which is the cost of capital. As a rule of thumb, we can say that for any company, anything you do, any project, any strategic initiative should always check this box that for this project, the return on the invested capital you're going to make in percentage is always higher than what your investor wish. This is usually the WACC. So those will be the main ratio or metrics I will look at.
Okay, and how do they exactly fit together, the EBITDA, ROIC, and WACC, and cash generation in general?
Well, they fit together. They should be looked at together, but I don't exactly say the same thing. The EBITDA margin is operating performance. It is the starting point. It is, of course, extremely important. You need to start with that. It tells you if you're able, if your business, regardless of investor or shareholders, if your business per se is able to generate something positive to create a margin, and this is the starting point. But again, that doesn't tell you about capex. And capex is very important. It can be also very scary. Maybe some of you, maybe Raksha, you looked at yesterday the Alphabet, so the company owning Google, published their financial results. The results are very good. The EBITDA is excellent. The sales are much higher than what the analysts expected. Analysts expected plus 15% compared to last quarter. It's much more. It's more than that. So we were all expecting the share price to increase in the future. Yesterday night, but actually the share price dropped by minus 7% just after the release of the result. And why? Do you know why? Because at the same time, Alphabet announced a substantial increase in the capex. So this is not captured by the P&L. So Alphabet is telling us we are making a very good sales target. We are very high on sales, very high on profit, but we are going to spend much more than expected for us to grow. And these investors, they don't really like it. They don't like it because giving the cash back to shareholders as a dividend is a risk-free. It's very easy. You pay the dividend, you get the dividend, and job's done. You reward your shareholders. By saying we are going to invest $180 billion next year in capex to increase the spending by $180 billion, you're making a bet. You're taking a risk. You want to fully focus on AI for the future, and investors, they don't like it. They're just spending without being sure there is a return on investment higher than the cost of capital. They may not like it. That's why we have to look at the return on invested capital and the WACC as a complement. And this also fit with the cash generation at the end. It's not a ratio here, but cash generation, mentioned in your question, is very important because with cash, you need to be able to generate cash to invest more, to pay out dividend, to make sure you will be able to cover your debt and your interest. So this is also something you're going to monitor. So those three, they always works together. EBITDA, you're profitable from a P&L point of view. ROIC versus WACC, what you do is higher than what is expected by your investors in terms of return. And cash generation is also very important because you may want to generate cash either to grow by investing more or to reward your shareholders by paying out dividends.
Thank you, Benoît. That's very clear. Frank, I have a question for you. Which KPIs do you monitor most closely at group and property level?
I will keep it short and simple, but I will maybe give you a surprising KPI as well, which hasn't been named yet. Obviously, I look at my RGI. Am I better than the competition? That is what I want to aim at clearly, and more basic, we always look at the budget we agreed on, and see how the years go. And then, of course, ultimately my ultimate number is EBT. This is how much do we make before tax. Okay, so and the third is the guest satisfaction. Are our guests happy? Do we get good comments? And if we don't, then how can we improve them? So in short, it's RGI, it's CQI, and it's EBT. And the fourth KPI, which is not on the list, I would call it, it's the employee happiness index. Because you bricks and mortar is important, but I know the most important component in order to be successful in the long-term run is do I have the best team available? So I look at how happy are they. We conduct 2 surveys with Gallup per year. We analyze them clearly, and we make sure that they really regard Althoff hotels as their home. All right, so it's not on the list, this KPI, but from a leadership point of view, I pay a lot of attention to this specifics as well.
Thank you, Frank. That's very helpful. I think it's important to keep the people in mind because they are the ones who are actually contributing to the performance of the company. With that in mind, speaking of people, we have a lot of questions from the audience. Let's switch over to that. So the first question is, how would you give a value or evaluate the quality perception by guests in order to compare yourself with competitors on market, basically backed with data?
So how we calculate that?
Yes, it says how would you give a value or evaluate the quality of perceptions by guest? So guest perception, yes.
Of course, yeah. I mean, first of all, perception is reality. That's important, that you look at the comments you get, and you accept them the way they are. But we measure them, we have Review Pro, if anybody's interested, it's a system you gather basically all the information you get from your own surveys, from OTAs, all kinds of remarks made by guests, be it on premises, be it digitally, is collected, is clustered, and is put together. You have your Booking.com rating, you have your TripAdvisor rating, you have many metrics, you put them together, you compute them, you cluster them, and then this is how other hotels do it too. And then you have your position you're 2 out of 8, 5 out of 8, 1 out of 8, and then and there is a percentage attached to it, okay? And then you can dive into, the clustered comments, where are people maybe not happy, what is a repeated comment, etc. So this is then from measuring it, how you then manage it. So it's pretty straightforward. It's pretty straightforward in understanding. It's not always easy in changing, right? Don't get me wrong. But it's the results you get, they are objectively correct, even though they might be subjective, as they come from a guest's point of view. But this is for us, that's our reality and how we look at it.
Okay, that's very clear. Thank you, Frank. So there's another question. What is the secret to not going bankrupt?
Okay, very easy. Always never spend everything you have. Keep €1 more than you need in the bank account. Okay, so that's I know it sounds super banal, but that's it. Listen, when we 2025 is over, Thomas Althoff, my partner, and we look at the results. We have of course money left. And we then there's a high retention of earnings within our company. And if you want to know, our equity ratio is 30%, 32%. Benoît will, I'm sure, also confirm that this is healthy. Okay, and hey, look, how often can you eat per day? How many cars can you drive? To talk from a very practical point of view, the company is our life. Okay, and we keep a lot of cash in the company, to reinvest. Because we have a second generation coming, and we want to at a certain stage hand over to them something which has value and is able to grow further.
Okay.
And maybe actually one story.
Yes,
okay?
yes, please continue.
And have a clear view on risk.
Mm-hmm.
So what does that mean? When let's say you go to Expo Real, which is a large real estate fair in Germany, there might be others in Monaco, etc. And then you just sense what's going. Everybody wants to grow, so grow. Okay, growth is important. We must grow, but the question is, how fast can you grow? How much can you digest? Look at our company. I cannot open 5 hotels per annum. It's impossible. I can, but it will not be successful. Hilton can open 150, 200 per year because they're large. They can do it. So be aware of what you can do. Have a strategy, by the way, and strategy is 50% to know what not to do. Okay, I repeat it. Having a strategy is 50% to know what not to do. Might surprise you, okay? Because not every opportunity is an opportunity. Not because you're adding a next hotel, If you're the one-day hero in your local newspaper because you just added the next cool hotel, and from then on, it's a painful partnership because investors were promised a lot of things, and you can't deliver. You just know it's not going to happen. The relationship will turn sour. You will overinvest your time in underperforming assets, etc., etc. So back to your question, this is how you, let's say, reduce the risk to go bankrupt and increase the risk to be long-term successful.
Okay, thank you so much. So maybe this one is one for Benoît. What are the ratios that I should look for when I choose a company over another one for employment, for example? So to consider this company successful or a great opportunity for me to grow, are there any ratios that I can look at? I think you're on mute, Benoît.
I still struggle with this mute button. But anyway, so yeah, there are a lot of ratios. If you're talking about listed company, I will choose one. It's the P ratio. So the P ratio is giving you the idea of how long do you need to get your money back. So this P ratio may be very high. It compares so very high for some company, like for example, like a Tesla, it's around 100, and very low for more risky company. So company near bankruptcy, so I don't have any example here in my head, but some companies are not very stable or not mature yet, will struggle with this. So the P ratio, the price divided by the earnings, or the earning per share, tell you how long do you need to hold one share to, in some way, I make it very, very shortcut, but to reimburse the value of the share. So meaning with a P ratio of 10, in 10 years, normally you get back the value of the shares. So these earnings, so price divided by earnings per share, these earnings that can be either pay out as a dividend, so meaning you get the money back as an investor, or that can be kept within the company and reinvested for the company to grow. Meaning, as I mentioned before, you still have the same shares, still the same price, but you are now shareholders of a bigger company. In both cases, the investor is winning. So this P ratio is a very good indicator. But now, if you want to invest into companies, what you need to keep in mind, it's the market is efficient normally, meaning there is no normally there is no great opportunity or there is no great risk when you invest in a company, because the market will evaluate the share price of a company risky at very low, and the share price of a very good company, Nestlé, Adecco, for example, or Microsoft, as very high, because there is no risk and there is a potential return. But if I would pick one ratio, I would pick this one, P ratio.
So are these the same ratios that you would suggest for choosing where to work as well? Because I think the question was more about which company should I work for based on their ratios? What should I look at?
Okay, so which company should I choose based on the ratio to work? Honestly, I have no idea. I'm not sure that that there is a ratio from a financial point of view to look at. Maybe you look at the turnover ratio from employee. If you see that there is 20% of employee quitting the company every year, this is, for example, the case at McDonald's. Then yes, McDonald's maybe not a company you want to join.
Good. Thank you for that. I think that's a really, really good aspect to consider. Coming back to Frank, which financial ratio would be the first to show deterioration if key operational talent were lost?
I think it is your fluctuation, right? How long, on average, do people tend to stay with you? Because talent drain is horrible. So I would look at how long do people stay with me, and how often would people leave. We would look, although, at different job profiles, right? Because if you have a young waiter, there's nothing wrong that maybe he or she leaves after a year to progress and choose other alternative. But if it comes to mid-management, more senior management, that would be crucial for me. I appreciate always a certain amount of fluctuation because you need fresh ideas, yeah. But it should be rather, I mean, for us as a family company, again, I look at it from a specific point of view. We like to, keep our team with us for quite a long time.
Okay, so turnover attrition to make sure that you're doing it right. Okay.
Yes, actually.
Okay, and then this may be also one for you. Where can one find the benchmark ratio to compare my ratios with the one of the competitor?
The question is to me?
Yes, or would you?
Yeah,
would you
sure.
prefer
I mean,
Benoît answers?
when you look at the index we talked about, you have STR, yeah, which provides you with the numbers you need. You have Review Pro, which provides you with the qualitative numbers. They're different. I mean, they're different providers. I'd say Benoît STR maybe is the most reliable source, or most companies, investors and operators alike share them. And with regards to quality, there are 2 or 3. But they're both very good, and they provide you with reliable, most of the time reliable numbers.
Okay, that's very clear. Benoît, for which time period should RevPAR be calculated? Do you do it on a daily or a monthly basis?
That's a very precise technical question. Maybe Frank maybe say a word about this, but from an investor point of view, we don't really care about short term. So we make models for 20 years plus a terminal value. So for us, it will be yearly. But maybe Frank, you're more well positioned to answer this.
Yeah. So obviously it depends what function you look at. The revenue manager, looks at it on a daily basis, for, the next week, the 10 days to come. I personally look at it on a weekly basis. Okay, I get all the hotels, and again, I don't have 500 hotels, but I look at all the hotels once a week, and I see, what the RevPAR is. I have it even on my, daily statement. You can glance at it, but I wouldn't glance at it every day because I need let's see, at least a week or a month to understand, if we are in tune with what we have budgeted. So a revenue manager looks at it every day. In my role, I look at it, with regards to RGI. Remember, RevPAR compared to competition, once a week, and then once a month when the numbers are more consolidated, and of course, it's part of our annual statements.
Okay, and then maybe there's something that relates to that question. What is the secret of a good partnership with your shareholders? How do you maintain that? Because you have your own hotels. How would you kind of give us some tips?
Well, I guess it might not surprise you. Okay, first of all, be open and transparent. Okay. Try to understand what the needs of the investor is. Okay, so don't do blah, 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 and focus on the numbers, the investor needs to have. Be proactive, okay? Don't wait. Sometimes things can, be difficult. Sometimes you might face a more challenging situation. Don't hide it, okay? Sometimes you might not be able to answer all the questions an investor has. Not a problem, don't make up something, take notes, have a look at it, and ultimately act as an asset manager yourself. And if you do so, you tick most boxes any external investors would like to see you doing well as well. And of course, be nice. Okay, most investors, are human beings themselves. Okay, treat them with dignity, okay, and be kind. That's more, maintain a good relationship. Look, we work with institutional investors. We have family offices. I make sure that if I are in town, that I go see them. Have a coffee sometimes. As banal as it sounds, update on things. Sometimes I even, let them look deeper in what we do. What's the strategy? What do we have in mind? What's the market? A lot of asset managers appreciate it. Some don't need it, but that's how we do it. So in short, okay, be transparent, be proactive, be kind.
Transparent, proactive, kind. Thank you for that. That's a really good summary. I have a last question for both of you. So how do you suggest we look at this one financial metric every hospitality leader should understand from the academic perspective and the professional perspective?
So one metric everyone should understand in hospitality?
Yes.
Yes, I would say the EBITDA margin. So this is a starting point, EBITDA margin. I would also say the trend of EBITDA margin, and if available, this metric for your hotel in your category. So we mentioned this before. It's not everything is not here. You need to look at cash. You need to look at your cost of capital. But this is the key, the starting point, EBITDA margin.
Okay, and Frank, how do you balance service quality, guest satisfaction, and financial discipline when guests are not always ready to pay for additional services?
Raksha, that's a question I could, I could take 10 minutes to talk about. I will try to make it short. Look, in reality, sometimes you think about innovation, you think about how can we improve service, what can we do better? If investment is needed, you have to have the ROI for that project in mind. But then sometimes, it's about trying. I mean, unless I'm not talking about investing 5 million and then we look how it works. But often it's, do we invest in new services? Do we need to engage more people? Do we create a new restaurant, etc.? Do we change the menu? Blah, blah. It's a lot of things. And often it's, you must make sure that from the idea, you also attach a number to it, when would we be happy? Okay. So, and if a guest wouldn't buy what you think is great, stop doing it. Look for something new. I mean, it's not, great entrepreneurs do not come from balance sheets, okay? So they really think about their business and how they can innovate, how can they be relevant, okay? And sometimes, and that's real life, you think something is great, your guest doesn't want it, or he likes it. If you ask, a guest, would you be happy if I put a bottle of Dom Perignon in your room? What's the answer? Of course, why not two? Okay, so is it going to give me anything in return? Maybe not. Okay, so a banal example, but this is how we do it. Okay, sometimes it's you try, it works. Be sure when would you be happy? Have a metrics attached to it, and if it doesn't work, okay, change it and try something new.
Thank you very much. That's really succinct, but really effective. I think we have come to the end of this session, and we have really enjoyed learning from both of you. I hope the audience has felt the same. And as you know now, finance is a leadership language, and there has to be an alignment between operations, asset management, and ownership. So I wish to thank both Frank and Benoît for all their insights and all the time that they have taken today. It is really appreciated. For you as a viewer, if you would like to watch back, remember you will get the recording within 1 week's time. You can watch it on our YouTube channel. You will also receive some information about EHL Hospitality Business School if you have opted in for this, of course. And if you're not able to wait, you're welcome to check out www.ehl.edu for all their amazing programs. And as you see, you have wonderful lecturers like what we've had today. So you must be in for something really good. And rest for that, please join us for our next webinar. Have a look at our social channels to keep in abreast of all of that. And we will see you here next time. Thank you so much for attending today. Goodbye.
Thank you for your attention.
Thank you.